Our next guest says April market weakness was probably long overdue, expects choppiness and volatility to come back in the coming weeks and months. BMO Capital Markets chief investment strategist Brian Belski has an S&P rating of 5,100, and he joins us now, which is exactly where we are now, Brian. So what do we expect going forward?
Well, good morning, Sarah. We came out with that call the last week in February, much to the chagrin of most of our investors. In fact, many people try to label us as an Uber bull. Let's just be clear on this. We're still very, very bullish longer term. We still think U.S. stocks are in a 25-year secular bull market. That's been our call since 2010. However, we do believe that the market so far this year, and really since October, the start of the second year of the cyclical bull market, has been more about FOMO and more about momentum and more about sentiment. And we believe many of our compatriots that do what we do have kind of left their process and discipline and try to chase the market. So we're sticking with our process and discipline. We're very, very comfortable with the 5,100 target year end at $250 of earnings. In fact, earnings are tracking around 241, 242. I think the Fed's going to be on hold longer than everybody thinks, and everyone's way, way too focused on Fed funds futures. Oh, by the way, they've been wrong for 18 months. We want to buy stocks cheaper. We think we're going to get the chance. We're not trying to be cute, but we're investors longer term. We're still very bullish, but we think we get a better entry point.
But does fine, Fed funds futures change and they can be wrong, but the 10-year note yield near 4.7, does that change the long-term value proposition if you don't think the Fed is going to cut anytime soon?
Great question, Sarah. So if you take a look at since 2007, we have reared an entire generation that believes you only buy stocks because interest rates go down or the Fed comes in and cuts rates. Not to the contrary. In fact, higher rates for these higher rates are very normal. We think this is kind of year 1 or 2 of normalization that will take 3 to 5 years as we kind of hover between 4 and 5% in the 10-year Treasury. Remember, the longer term 75-year average on the 10-year Treasury is 5%. So you have double-digit earnings growth, double-digit to low single-digit, high single-digit, low double-digit performance. In the stock market, all very normal. With respect to valuation, we're very normal too. So this is a situation where earnings, look today, are driving the market. We believe that on a near-term basis, again, from a price perspective, we're ahead of ourselves, but earnings are going to be the key longer term. We just want to buy stocks a little bit cheaper.
Are earnings expectations moving higher, though?
Another great question. Coming into the year, revisions were quite negative, and we've been calling for this earnings revision cycle to improve. We continue to see that. Now, typically and historically, we're starting to see some of the historical precedent follow through some tech stocks. Now, semiconductors in particular, from an industry perspective, have been amongst the most volatile earnings longer term. And now we're starting to see that. Now, we have a big number coming out on May 22nd, NVIDIA. That's going to be a really great one for the market to gauge that. We actually trimmed our NVIDIA position a little bit. We're not overweight anymore, and I think that's been the right call as the market's been kind of soft here. But we do believe from a sector perspective that financials by far are the area that we're going to see the biggest uptick in earnings, especially as 10-year Treasuries continue to hover in these average levels between 4 and 5%. We're long tech from a sector perspective, and we're long financials.
Got it. Brian, thank you for talking us through the strategy. Have a good weekend.
Thank you.
Brian Belski.